Thank you everyone for being here today. Can you all hear me? Very good. All right, excellent. In addition to myself, I'd like to introduce my colleagues. We've got Matt Bernstein, Chief Plan Giving Officer, Cynthia Hazami, Robin Dermer, and Judy Feig. And together we feel that we make up one of the finest plan giving teams there is in the country. We focus on helping our donors and our partners with tax strategies and helping them get out of, and work to make their taxes more efficiently in the areas of donor advised funds, charitable gift annuities. We work in real estate, appreciated assets, and straight up cash gifts as well. We're also proud to be a part with Jewish National Fund of the Jewish Future Pledge, in which people are being asked that you commit 50% of your charitable dollars. So if you're giving $10 to charity, that $5 of that goes to Jewish causes to be able to help secure the worldwide movements of the Jewish people and the Jewish future. I'd like to now introduce Mark Horowitz, Managing Director and Private Wealth Advisor at Morgan Stanley. With over 25 years of experience in the financial markets, Mark provides comprehensive wealth management strategies and services for high net worth individuals and their families, as well as nonprofits. He's especially adept at navigating complex wealth management issues, such as estate and tax planning, to help ensure a holistic approach to total wealth management. Additionally, Mark is a regular contributor to podcast Kosher Money and Meaningful People, in which it's garnered over 1 million views. He's the author of You Revealed, lecturing all over the world on self-development, finance, and business. Mark is active in many charitable and community causes and organizations, and we thank Mark for being here today.
Hi, everyone. You hear me well, Bill? Excellent. I'm just going to share my screen. There we go. Can everybody see that? Okay, let me just turn this into a slideshow. There we go, from the beginning. Okay, so I recall distinctly when Matt first floated this idea. It was back in the early spring, Matt, you remember? And the market was doing what the market does. And when Matt told me when it was, I said, oh, that's not a problem. By then, everything will have worked itself out. Well, here we are, and things have not yet worked itself out. So we're having another interesting year in the market. And in an interesting year in the market, the types of information I'm going to share with you today is as relevant as ever. Why is this working? Okay. Well, I always begin by sort of pointing out how terrible human beings are at investing. Investing should be actually a pretty simple endeavor. We pick an asset, we take a long-term approach, we stick with that asset, and we sell that asset only at such time when we need the money. This is the way successful investing is done by the likes of Warren Buffett and John Bogle and others. We read about such people, we read about the wealth they created, and then we try to do exactly what they do. But for most of us, things don't work out as planned. So over the last 20 years, and this data goes back even longer than that, the average investor amongst us has earned 2.5% during a time when the 60-40 benchmark earned 6.1. And that's a very, very poor showing. So we were underperforming even a diversified, moderately conservative benchmark. And the average investor, as a result, has barely kept up with inflation. So there's a lot of things that we're doing wrong. Books have been written about this, all the biases and all of the tendencies of individual investors, and all of the plans that get torn up and go awry in years like this year. This is a year when trillions of dollars have left the market. This is a year where we are being tested to see whether or not we are psychologically ready or not to invest in the capital markets. I want to point out 4 things today, just 4 things that are not exactly typical. These are typical mistakes that I see investors making. These are mindsets that if you can internalize them and realize how they trip you up, you will be well on the road to becoming a much more successful investor. The first is that we overestimate our power to predict. We have seen predictions in the last 3 years, one after another, go awry. Predictions that went exactly the opposite way. If you follow the press this year, you will find when the market is down for a consistent amount of time, everybody continues to talk negatively. As soon as things turn up, for no apparent reason, everybody starts to talk positively. We all jump on the bandwagon after the fact, but before the fact, our predictions are absolutely awful. Let me just share some of them that I've observed lately. Last year, inflation was a temporary supply chain issue. Everybody was certain about that. It was purely supply chain driven. Even the Fed was saying that this is not anything to be concerned about, and therefore quantitative easing was left in effect. Interest rates were left extremely low. And then it became apparent that this was not just a supply chain issue, this was a money supply issue. And today, people are saying that inflation is here indefinitely. We're going to see 4 to 5% inflation as the new normal. Last year, the prediction of temporary supply chain issue was as ironclad in the minds of those predictors as today it is that it's here indefinitely. We began with there won't be a recession. The Fed was confident that they would stave off a recession. Then it turned into a safe landing. We're going to have a soft landing. We're going to be okay. Things will moderate. Now, everybody's talking about a hard landing, and the only question is how hard it's going to be. Everybody that I've listened to in the last 3 months has somehow come up with the same number. The S&P is going to 3,200. I've heard this some of the smartest people on Wall Street, and they've said 3,200 is the number. It's a retracement of the S&P to its pre-COVID number, and that's where we're heading. Well, we're not there. Interest rates are going much higher. Yet, look what happened the last 3 days alone. The 10-year Treasury has rallied. Its yield has dropped from somewhere around 4.4 to somewhere around 3.8. And everybody's left scratching their head and trying to understand why. What we need to resist is the urge to predict. Even worse than that, the urge to act upon those predictions. Predictions, you have to know, sell papers, keep people watching their screens, and they keep all these gurus employed. So I want to teach you something, which is absolutely true. I've proven this to myself every single year that I've been on Wall Street, watching all the pundits try to predict what's going to be. The fact is, nobody has a clue. You should just write that down. I'm telling you, nobody has a clue. I've been on Wall Street for 20 years. I've worked at some of the greatest firms out there. I've heard from some of the greatest portfolio managers and economists and market strategists. None of them have a clue. They're all guessing. And they're as right as often as throwing darts at the wall. Even the Fed doesn't have a clue. If they had a clue, we wouldn't be where we are today. They are humans just like you and I, and it is impossible to predict what the market will do, what interest rates will do, and where inflation is going to be 1 year from now. So anytime somebody is giving you these types of predictions, you must take it with a grain of salt. And if you're acting upon those predictions in a way that isn't beneficial for you in the long term, you are more often than not going to be making a huge mistake. 2020 should have proven that to all of us. We lived through the worst pandemic in modern day history. 6.6 million people died, businesses were shuttered, double-digit unemployment, and the S&P fell from February of 19th to March 23rd. That's unbelievable. That's like 5 weeks. It fell 34%. I remember those 5 weeks. I had COVID during those 5 weeks. It was absolutely brutal. Now, at that moment, there was not even a glimmer of hope. Nobody would have predicted what ended up happening, which was a 52% swing in the S&P 500. So if you were as certain as everybody else that 34% was just the beginning, unemployment was going to go up to 20%, and that the world was going to have something it's never seen before, then there's no way you stayed in the market. No way whatsoever. The only reason why you stayed in the market was that you had a long-term approach and you said, nobody knows how this is going to end. And literally 6 months later, the market was flying high and trillions of dollars were sitting out who thought they knew better. The market in reality is the opposite of the weather. Weather, the longer you go out, the less likelihood your forecast is going to be right. It's pretty easy to predict the weather today. It's much more difficult 7 days from today. And then the 10-day forecast is correct about 50% of the time. Markets, the shorter the time frame, the less predictable they are. It's impossible to know what the market's going to do tomorrow. It's sometimes impossible to know what the market's going to do at the close when it is opening. Sometimes you see future numbers that are negative, and only an hour later, the market opens up strongly. It's like watching a basketball game and turning it off before the end. You just don't know who's going to win. As you go out longer, markets become extremely predictable. So predictable that over 90% of the time, it stays within one standard deviation over any 10-year period. There's a great quote from Jeremy Siegel, which I always think about. Over the long term, the market has delivered an inflation-adjusted return of between 6 and 7%. That means the higher inflation, the higher the market return, because inflation is a driver of the market over the long term. This will continue, and it's simple mathematics that risk will pay an above inflation return over the long term. When you see inflation today, it will scare you. And stocks don't like inflation over the short term. That's expected and normal. It leads to higher interest rates, and not all companies can pass on inflationary costs to the consumer as quickly as they would like, which squeezes margins in the short term. In the long term, inflation is the market's best friend. It leads to higher earnings because it brings higher prices to the consumer, who pay more for goods, and therefore the companies earn more money. Second, the seduction of pessimism. When we get pessimistic, it feels good. These are two great quotes that underscore, I don't have to read them for you, you can read them yourself on the screen, is that for some reason, people are attracted to and listen up when somebody is predicting the worst. Pessimism is more common than optimism. That's the reality. This has to do with risk aversion. It has to do with fear of loss. Pessimism sounds smarter. Optimism sounds like the person is somehow unrealistic and oblivious to risk. But when somebody walks into the room and says, things are bad and they're getting worse, here's why, we perk up, we listen up, we're captivated by it, and we somehow feel that the voice is here to protect us. We have to be cognizant of the fact that we are attracted to pessimistic outlooks and predictions in the market, in the economy, in society, and in every which way. Pessimism is why many of us are lousy investors. A person who is a successful investor has to have an optimistic outlook. A little pessimism may be good because it has us check our assumptions and do due diligence and stress test the types of things we're investing in. But the fact is that it's impossible to hold on to equity positions when you are pessimistic and you have a dour outlook. The reality is, as I always say, capitalism survives. Companies return to profitability. If not, cash will not be of any use. The alternative to a rising S&P 500 over the next 20 years is essentially the end of capitalism. And in the end of capitalism, there's no place to hide. You have to realize that no matter how much you think you know, that things will normalize 2023, 2024, you have no clue. Nobody has a clue. And therefore, the only way to make money in the market is to feed yourself healthy thoughts, stay optimistic, and stay invested. I always remind myself that greed wins out over fear. The market swings from a pendulum of fear to greed and back and forth. We have seen a year of swings, which is just almost unprecedented. Days where it looked like everything was going to fall apart, followed by one good report, and the party begins all over again. The reality is that over the short term, fear and greed swing, but ultimately it is greed that wins out. The reason why I'm optimistic about the market going forward are the next two slides. The US government has dumped trillions of dollars onto our economy, into the pockets of households. Those blue bars that are in the circle is the amount of excess savings that was accumulated during COVID. A lot of that excess savings went into the market. A lot of it is sitting in cash, as we're going to see on the next slide. Of those $2.6 trillion, it's estimated that only $546 billion of it was spent, meaning there's $2 trillion of liquidity still waiting for a place to go in a high inflationary environment, which means that if it's sitting in a bank, it's losing today about 6% or more to inflation. The people who are holding that cash are waiting for the opportunity to invest. They're watching the markets, and that's why one good report brings floods of money in the blink of an eye. This is what it looks like right now. $3 trillion in excess savings is sitting inside checking accounts. You all know what checking accounts pay or don't pay. This is an astronomical number. This is an all-time high. This is what's going to fuel the next bull market. You want to be in there before these $3 trillion go pouring in. On the flip side, one of my pet peeves, Matt knows, is that too much greed can be highly detrimental. What do I mean by that? You should learn to be satisfied with market returns. The market has delivered extraordinary returns over the long term. 6 to 7% above inflation is a reasonable return for something that carries the reasonable risk that the market does. So unless your full-time job is to analyze stocks and trade them, I encourage you to bet on markets and not on individual stocks. There are thousands of stocks in the US market universe. you will never be able to analyze all those stocks to pick the ones that you feel are best. And no matter how enamored you are with one company, you don't know nearly enough about it, and certainly don't know enough relative to all the other companies in the universe. JP Morgan did a research report, which I think is very fascinating. They looked back at the market since 1980. And what they found is that a full 40% of companies lost 70% of their value during that time and never recovered. Which means, think about it, out of the S&P 500, 200 of the 500 companies lost 70% and never recovered. So if you had even one of those companies, and heaven forbid, two of those companies in your portfolio, by the way, statistically, you should have had 4 of them in your portfolio, you will never recover on those 4 stocks. Market returns were driven by 7% of the companies, which outperformed by 2 standard deviations. So what happened is that 7% of the companies completely overwhelmed the 70% loss delivered by 40% of the companies, because they so outperformed that they tipped the scale well into positive territory. So if you didn't own the 7% and you owned too much of the 40%, or didn't own any of the 7% and owned a lot of the companies in the middle, or some of the companies in the middle and some of the 40%, you had a horrible return relative to the S&P. Great part about screen sharing is that you can fix a typo while you're talking. So when you bet on the market, you are getting one of the greatest evolving instruments known to mankind. I did this on a podcast about 8 months ago, and I've gotten hundreds of emails across the world where people have written to me and thanked me that they never really understood the benefit of the S&P 500 as an example relative to a portfolio. So let me explain. The way a market index works, the S&P 500 is comprised of 500 stocks, but each stock does not comprise the same percentage of the S&P as the other stocks. If you look at the top heavily weighted stocks in the S&P, you will find companies like Google, Tesla, Microsoft, Apple, NVIDIA, and Amazon. These companies did not even exist in the S&P, or some of them did not exist in the S&P 10 to 15 years ago. If you looked at the S&P 10 to 15 years ago, you would have seen a whole different subset of companies. If you looked at it 30 or 40 years ago, you would have seen a completely different subset of companies. I'm sure at one time, railroads, banks were the biggest representations in the S&P. Now you have technology as your front runner. If you own a portfolio of individual stocks, as many people do, I always find that the stocks will represent what was innovative at the time that they assembled that portfolio. For some people, it's healthcare. For some people, it's utilities. For some people, it's banks. For some people, it's a mix of all of the above. And they have virtually no true current day innovators in their portfolio because their portfolio has become outdated. If they had just bought the S&P, their portfolio would have evolved as innovation evolved. And that's where their extraordinary returns would have come from. The second benefit of owning the market is years like this. It's very hard to know who the winners and losers are going to be from a high inflationary environment, high interest rate environment. And when things get very, very uncertain, you become extremely uncertain about individual stocks. I have a client who's owned Home Depot forever. And this year he sold. He sold because there was a confluence of issues that he felt will hurt Home Depot. I don't know if he's right. I don't know if he's wrong, but he capitulated. It's much easier to wrap your brain around the fact that the S&P will recover and that there are companies inside the S&P that will benefit from higher inflation, than to wrap your brain around all that being true for any one individual company. On that same note, I'm sure many of you have actively managed mutual funds or separately managed accounts versus owning straight S&P. I am a big believer that it makes absolutely no sense to use actively managed funds. 94% of actively managed mutual funds underperform the S&P pre-tax. Post-tax, because of all the trading that goes on in these funds, it's even higher. Over the past 20 years, this is not my data, this is S&P Dow Jones data. If you go back 30 years, 40 years, 50 years, it's not that different. Despite that, astonishingly, there's $5 trillion invested in these funds. If there was any other industry that has 6% success rate, the industry would no longer be around. For some reason, this industry continues to thrive. That reason is greed. It's that most people, as I began in the first bullet point, do not believe that the market in and of itself will deliver ample returns. They're looking for more. The marketing of these types of funds will always play to that greed inside of us. S&P returns are for the regular guy. We're special. We have this special fund, and you can earn more. Well, you can if you are perfect at getting it right, when 94% of the time you won't. The last thing I want to tell you is I've been on Wall Street a long time. I become extremely skeptical of esoteric, high-priced, lofty outcome promising funds and investment vehicles. Just to highlight one, hedge funds. My screen isn't changing. There we go. In 2011, Warren Buffett basically came out and said hedge funds are essentially ridiculous. And he made a bet with the hedge fund industry. He bet them that over the next 10 years, they will underperform the S&P 500. This is the result of the annual returns of the average hedge fund versus the S&P. Astonishingly, there was not 1 year where hedge funds beat the S&P 500. I've been an advisor on Wall Street for 20 years. I consistently look at the universe of hedge funds available to me at the great firms that I work at. I consistently benchmark those funds to a typical 60-40 S&P 500 bond index, and more than 70% of them return a lower return than the S&P in any given year. Why do we buy hedge funds? They're special. They're exclusive. We think there's something there, and therefore we walk away from market returns and we are gravitating towards them. So let's sum this up and then we'll take questions. You should resist the urge to buy into short-term market and economic predictions. The less you read about what people think the market's going to do, the better investor you're going to be. Stay away from the news. Stay away from those headlines that claim to know what inflation is going to do, what interest rates are going to do, what the market's going to do, when will be a good time to buy, and when is a good time to sell. Whenever you're feeling pessimistic, speak to people that are optimistic. Seek out information which brings optimism into your universe, because it is optimism that will make you a great long-term investor. Remind yourself that greed drives markets over the long term. People are greedy. People need to earn an above inflation return. They will come back into the market. You must be there when it happens, and you will never know when it does. And lastly, Don't overcomplicate your allocation. Don't have things in your portfolio that you don't understand. Know why you own what you own. And if you don't know why you own it, don't own it. Because when the thing does things that you never predicted, you will sell it at the very worst time. So therefore, you're better off owning simple, straightforward, transparent things, which make total sense, which are tied to capitalism and are tied to the long-term direction of the market, which is ultimately always up. But with that, we'll take questions.
Mark, thank you very much. Can you hear me?
I can.
Excellent. So we'll start with some questions that we have. The first one is, Treasury yields have been coming down for 30 years, which has supported the equity markets. What happens if the yield and inflation continue to remain elevated or rise?
So that Treasury yields have come down, I would not say is why the market has gone up. It hasn't been an either or. It hasn't been that. You don't see data supporting that money has been leaving treasuries and going into the market. It's not what's been fueling the market. Without a question, low interest rates are a boon to the market. But the market has thrived in higher interest rate environments than we even have today. There is no question that we've had a bull market in bonds. So when there's a bull market in bonds, treasury yields coming down or bond yields coming down, it means that more people are buying bonds, which is causing prices to go up and yields to come down. We don't need that type of environment for markets to thrive. We need stable interest rates and we need stable inflation. But it's important for people to keep in mind what's driven the market is innovation. That's what's driven the market. The market is driven by three components. And this is very important. I think I said this on the last time we had a webinar, but I want to just explain it again because it's extremely important. I showed on the slide that over any 15-year period, the markets have always gone positive. How do we know that the markets won't just trend down for the next 30 to 40 years, right? Maybe it will reverse itself. And the answer is, there are three things that drive the markets over time. One is inflation. It's simple mathematics. If a bottle of milk costs $3.99 instead of $2.99, that dollar is being collected by the company that makes the milk. After finishing paying their higher wages, their higher freight costs, their higher packaging costs, as long as they maintain the same margin, let's keep that at 20%, they're making an extra 20 cents on that dollar that they're charging you more for the milk. That 20 cents falls into their bottom line, which is why stocks have kept up with inflation 100% of the time over the long term, which is what Jeremy Siegel is claiming. The second component of the market is GDP growth. Put another way, population growth. The GDP of the world's economies continues to go up over time because more people mean more consumers. And the third is innovation. We have innovated. We have created more with less. We are creating things today in seconds that used to take days or weeks. And it's costing us so much less. People look at today's technology, a phone, a TV, a car, and if you think about how much it would have costed to make this type of a product 10, 15 years ago, it would have to cost you 3 times the price. The reality is that innovation has brought down the cost and made things accessible to the average consumer. Those 3 things drive the markets over time, not lower interest rates. Lower interest rates give an extra boost to the market, but they're absolutely not necessary. So this goes back to the whole prediction thing. We don't know where interest rates are going. We don't know if treasury yields are going to go higher and stay higher, but they're ultimately the market will adjust and it won't matter over the long term because as Jeremy Siegel said, 6 to 7% above inflation returns is what we should expect. Next question, Bill.
Thank you. Do you have an example of a mutual fund that is not managed?
Yeah. Well, let me define the word mutual fund and ETF. There are passive and active mutual funds, and there are passive or active ETFs. The difference between ETF and a mutual fund is very simple. An ETF floats on the market like a stock. You buy it and sell it on the open market, and you get the price that you pay for it the moment you buy it. It's liquid instantly, and you buy it instantly. It's a great innovation, one of the greatest instruments that have been created in the last 25 years. A mutual fund is different. You are buying and selling shares to the mutual fund company. That transaction takes place at the close. If you put in an order for an S&P 500 mutual fund at 9:30 a.m., you will get the price that it closes at 4 p.m. You will not get the price that it is at 9 a.m. If you sell it at 9:30 a.m., you will get the price that it closes at 4 p.m. This is why many people have moved from mutual funds to ETFs. ETFs are almost exclusively passively managed, meaning they are indexed. S&P, Dow, mid-cap, small-cap, technology, and so on. Most mutual funds are active. They are actual managers who are picking stocks from within the universe and trying to beat the market. There are passive mutual funds, such as Vanguard and BlackRock. I scratched that. I'm not sure if BlackRock makes passive mutual funds. But the same way you can buy the S&P in ETF form, you can buy it in mutual fund form, but that would still be a passive mutual fund. Does that answer your question, Bill?
I think so.
Okay.
Another question. Thank you. Okay, so she has a follow-up. How do we know when a mutual fund is not actively managed?
Look at what it is describing itself as. Passively managed means you are buying an index, and it will say so. An index means you're buying a representation of whatever that index is. Today, the world of indexing has become so diverse. So it used to be that you had a choice of vanilla, strawberry, chocolate, and pistachio, right? You can buy the large cap, mid cap, small cap index. You can buy US and international, emerging markets, and so on. With the proliferation of ETFs, you can now buy any subset of the market that you want, such as technology, biotech. You can even buy robotics. You can buy cybersecurity. You can buy aerospace, and so on and so forth. When you buy an aerospace ETF, as an example, or you buy a healthcare ETF, as an example, you are buying all of the healthcare companies which reside inside the S&P, as an example, and in the same weighting that they are represented in the market. So the bigger companies will have a bigger weighting in that ETF, and the smaller ones won't. There's no manager involved. This is simple metrics and mathematics. And they are just packaging parts of the market for you and leaving it alone. The only time these indices change is when the S&P or whatever index you are tracking decides to add or subtract. So if you own the S&P when Tesla was added to the S&P, you woke up the next morning, and even though you didn't notice it, but you now owned Tesla. An active manager is constantly looking at the portfolio and trying to do better than the S&P by buying and selling stocks that he or she believes is going to outperform the broader market. In doing so, they incur higher fees, they incur frictional costs, trading costs, and taxes. And the fact is, most of them get it wrong. With all their research, it's almost impossible to beat the actual market.
Thank you very much. Next question is: what are you currently thinking with regards to the markets and inflation?
Can you elaborate on the question?
Let's give me 1 second. We'll come to another question. We'll come back to that. You talked about technology stocks, and where do you see technology investments going in the future, especially since the last 2 years they were the top stocks in the S&P?
I am a big believer in technology. The word technology is a very, very broad term. It encompasses many, many parts of the market. I want to use the word innovation instead of the word technology. I'm a big proponent of innovation. And the way I allocate my clients is that I try to overweight innovation wherever I see it. So we have innovation today in biotech. We have innovation today in information technology. We have artificial intelligence. We have quantum computing. We have self-driving cars. You look at innovation, and that is where I want to have an overweight. You don't have to get complicated because, as I said, the S&P 500 in and of itself will represent or overrepresent innovation. So the S&P 500, there's two schools of investing. There's value and there's growth, right? Value stocks, we tend to look at as old economy stocks, although that's not always true, but it's for the most part true. And growth stocks tend to be new economy stocks. Years ago, I'm sure many people here remember, if you took the S&P and you sliced it into value versus growth, value was far more represented than growth was. Today, it's the opposite. Growth is far, far more a representation of the S&P. So by buying the S&P, you are by virtue buying innovation today in a large degree. If you are a long-term investor and you have a stomach for a little bit more volatility, the answer is you can buy an ETF that gives you a little bit more innovation. Everybody knows Kathy Fisher's fund, ARK, which was marketed as an innovation fund. I think a lot of people didn't realize that when you buy pure innovation and certainly emerging innovation, you're subject yourself to a lot of volatility. You don't need to do that. You can buy large cap indices such as Vanguard's Technology Index and others like that, where you can put a greater weight to innovation. And really, you want to think about, what do you believe in? What do you have conviction in? If you have conviction that ultimately a lot of what we do today will be done differently, and you believe and you have conviction in certain sectors that are going to benefit from that, well, that's the kind of thing you want to buy and overweight and just stick with it and say, this is something that has a high degree of likelihood it's going to work out over the long term.
Thank you very much. We'll go back to the current thoughts around the markets and inflation. And inflation seems to be moderating. Is it real? Is it just a blip? What do you think?
So let's go back to rule. Rule is nobody has a clue. And I'm not saying that I don't have an intuition about it, but I always check my intuitions and begin with, how many times in my life did I think A would happen and B happened? I could have sworn that we would have had better inflation numbers last month than we had. I wasn't surprised that we had better inflation numbers this month because this was overdue, because the underlying data was pointing to the fact that the pressures that were causing inflation were easing, right? Now, if you ask me what my intuition is that the worst is behind us. However, that the worst is behind us is not a complete answer. It's how quickly and what is the trajectory of inflation to come down. Remember, inflation is corrosive. Unless we have deflation, God forbid, the longer it sticks around, the more things are going to cost. I don't think a dozen eggs is going back to $1.99, right? This is what it is. This is the new norm. Now, 7% inflation is nothing to throw a party about. It's certainly better than 9% or a continuation of a rise. But whether we have a recession or we don't have a recession, and all these other questions that are swirling around, has as much to do with how sticky inflation is and how slow it is to abate, versus where it is 3 or 4 years from now. So my intuition tells me we've seen the worst. However, I also go back and say, I could just as well be wrong on that as well. And we can have a horror of inflation next month and everybody can go into a tizzy. However, the market, I want you to disconnect your thoughts about the market from your predictions around inflation, because there can be so many other things that cause the market to go up or down, even if you get that inflation prediction right. Right? So therefore, associating market returns with where inflation does or doesn't go, yes, it's bantered around in the press, and all the geniuses say that they're correlated, and there definitely is some correlation there. But there's so many other factors that can cause the market to go up and inflation go up at the same time, or that can cause the market to go down even while inflation is easing. So my feeling is we've seen the worst of it. My feeling is the markets will be just fine, but I cannot tell you if something else will come to swipe us.
Mark, on behalf of all of us, thank you so much. The team, Matt Bernstein, Cynthia Hazami, Allison Nagelberg, Robin Dermer, and Judy Feig. Thank you for being here. Thank everybody for taking time out of your day to be here with us today. If you'd like to connect with our speaker, with Mark, please, we'll put in the chat his website. And we thank you, and we look forward to seeing you again.
Thank you, everyone.